Good evening, everybody. Welcome, welcome. We're going to give it our typical minute or two. Let those joining us jump on in. I'm even going to hurry and let me just see if anyone is hanging out in Shirley. Maybe. Hi, Perry. Hi, Bob. Good evening to you, Stephen. Good to see everybody. We're already in the second half of January. How's that? Just so fast already. Good morning to you, Sandy. Okay, audio's on. Everyone's good. Officially, welcome out to the Market Watch Group Trading Foundations. We are on version 2.0. Very exciting stuff. Today, we are continuing a discussion in the realm of risk management. Right? We laid the foundation. We talked about some specific concepts, some terminology, some ideas and methodologies that you want to be aware of in implementing. But what I said was the way that we manage risk in a trade, the biggest thing that I have, the biggest conclusion I have come to over the years is that my thought process cannot maintain the same perspective. I can't see it the same way early in the trade as I do mid trade and as I do late trade. I can't see it the same when things are going right, when things are slowing down, or if things are going wrong. So I have to have a better sense of the context of where that trade is relative to what I was expecting. And then I can customize my risk according to those stages. And that's what I realize as I'm describing stages. Like, what are these stages? And of course, this is not some end all be all. These are the stages. These are the Scott Beck. This is how I break a trade into four components. One of those components has early and late. So technically, four with two subcomponents. What if someone's like, you know what, I like that idea, but I'm going to make five stages. I'm going to do whatever makes it easier for you to understand that how you see it, what your priorities are will change relative to these different stages in the context of a trade. My name is Scott. I will be your host for Stages of a Trade. Gary will be back. I believe it'll be next week. I need to get a hold of him. We've both been a little busy and need to connect. These are the disclaimers. As always, remember, we are not advisors. This is education and illustration for techniques, for information, and for methodologies. Let's talk about the agenda for today. Intro to the stages of a trade. What do we mean? What do the stages mean? How are we breaking it down? Then you can see there are four key stages that we're going to talk about. We're going to define what they are, pre-trade. Then we're going to talk about what's the thought process. What are the considerations that I need to have as it comes to risk and managing the trade. Then we'll look at stage two. So stage one, you can see, is pre-trade. Stage two, waiting to develop. I'm in the trade, but I'm waiting for it to really start doing what it is I thought it was going to do, what I wanted it to do. And what are my risk considerations and what is my plan of action when I'm in stage two? Stage three, momentum. We need to know what it looks like when we move into stage three. We need to know what our risk considerations are in stage three. And we need to know what it looks like as we get towards the tail end of stage three. And then we get to stage four. So stage three is the momentum phase. Things are doing what you thought. Stage four is nearing completion. A few different ways that we can define nearing completion. But when you know you're getting to the tail end of a trade, what are your risk considerations now? And you can see that it's got to be different. They're so different, these different stages. What's happening and what am I seeing and what am I expecting? We'll sum it all up. That's our agenda stage. So again, and you may change the name if you think, I don't understand what you mean. So stage one is pre-trade. Before you take the trade, what are we doing? What is our due diligence? That's mostly our technical analysis. If all the indicators make sense, if all the numbers make sense, we move and we say, let's go ahead and take that trade. Now we have a job, position sizing, reward to risk. All those are things that we do in stage one. Stage two, we took the trade. Now what? Well, we kind of have to sit on our hands a little bit. We can't just be like, all right, better start working the first 7 minutes of the day or I'm out of here. No, we know we have to give it some room, some time. We have to let that trade develop. Develop into what? Stage three, momentum. Now it's moving. Now it's doing what you thought it was going to do. Look at it go. I don't care if it's a day trade, a swing trade, position trade. These are all very similar in you expect something. What does it look like when it starts to do that? If it's a swing trade, I'm just looking for one move, support up to resistance. Great. When it hits its stride, I'm thinking, okay. When this thing starts slowing down and getting to resistance, I'm getting ready to get out. Steven says stage 5 could be a post-analysis, a post-mortem. You know what? I agree. I mean, I don't consider it a stage of the trade. Certainly you could call it that. I consider post-trade analyses part of my record keeping and analytical plan. So this is for me, and again, I like where your head's at. You want to include that as part of the trade, great. You log it and you figure out what can I learn from this. I like to do I don't do every trade these days. Some trades I'm just like, yeah, I know what happened here. Sometimes I just do like a random, like I'm going to pick 3 winners and 3 losers, and I'm just going to go back in time and I'm going to assess them. I'm going to assess the different components. What was my setup? Was it good? What was my trigger? Did I rush? Did I take a good trigger? Did I have a stop and a target? Did they look reasonable? Right? Did I execute my plan? Did it go right? Did it go wrong? Right? Just I like where you're thinking. There's always something we can learn. So yeah, if you want to build that as part of the trade, love it. Love it. Uh Stage 3 momentum, it's moving. For me, Heiken Ashi is a great way to both signify that we've entered the momentum stage as well as use it for a mechanism for where and how much to move our stop in an ongoing fashion. Stage 4, nearing completion. If you have a target, when it gets nearer to that target, if there's an old resistance level, if there's amount of time and you're nearing the end of time, maybe it's nearing the end of expiration. There's a few different ways that you could look at that, but you got to have a sense of when is this trade really starting to come to the end. I need to be much more aggressive with my stops and how much risk I'm willing to take if I believe it's near the end. If it's in the momentum stage, I'm going to give it a little room. Like, hey, let's see how you can do. I'm not gonna get in your way. I'm not gonna trip this trade up. But when we know we're getting close to the end, now we've got profits to protect. Let's tighten our stops. Let's start to pair out and sell a little bit with some scaling strategies. Okay, let's go through them one by one. Questions as we go. Stage 1, pre-trade. When are we doing this? What's happening? So this is before we take a trade. This is during what we would consider trade setup. We have a strong watch list, and on that watch list, we have a stock that starts pulling back, and we think, look at this. This pullback is potentially setting up the next entry, the next higher low where I'm going to place my trade. But I don't have confirmation yet. If I have confirmation, I've got to really work a little faster and make sure that I'm not rushing the trade. But ideally, we're doing this before the actual trigger of the trade comes. Where I told people this week, start running your numbers anytime. The signals came today, bam, right? Start running your numbers. Be ready to get trades on if you start to get signals. Not all signals, but definitely some. What are we doing? We're waiting for the trigger, and we're starting to develop the stop loss. If I take this trade, where will my stop loss be? I'm implementing and identifying my target price. If I'm right, how high will it go? I'm trying to establish the time frame. How long is this trade likely to take? Bare minimum, those 3 things. Stop, target, time frame. That's going to, at the very least, give me a reward to risk ratio. We can see one of my primary considerations is, do I have a reward to risk ratio that meets my rules? Do I have a valid confirmation, a valid trigger as I wait? If you want to go a little deeper with some what if scenarios for time, or for maybe there's a couple of levels where you're like, I might sell some here and then some here. Great, whatever you want to do there. This is the bare minimum. Your target, your stop, your time frame. Very, very important for us to have those and make sure that we have met the rules and that we have a valid confirmation for the trade. What's our key focus? You're balancing your chart signals. Do I have candles? Do I have stochastics turning? With our trade parameters, making sure that we adhere to reward to risk. I can't be like, oh, look, I have a trade signal, but I have 1.5 to 1 reward to risk ratio. Right? I can't have 0 signals versus 2 confirmed signals. If I am more aggressive, I might be willing to take 1 where I say, I don't have the stochastics yet, but I'm going to go on price because I'm in a bullish market, because I have a stronger bullish posture. A little bit of that has subsided for me as of now, but there are still definitely some trades I'd be willing to jump on. Okay, what are our risk considerations here? First and foremost, primarily our risk consideration is your initial stop loss. That's going to define your risk so that you can then quantify your risk by position sizing and understanding how much you're going to lose if it drops to that level. Doesn't matter if it's a stock, if it's an option. You need to know if it drops to your stop loss level, how much will your trade lose? Then we can position size it. You can see position sizing is in our our stage 1 considerations. Reward to risk. I need to know where I'm right in order to see how much do I make if I'm right versus how much do I lose if I'm wrong, and what is my reward to risk ratio. I need to justify my risk. And the last thing we're doing in stage 1 is we're already starting to think about our scaling and our risk management strategies. Am I going to tighten my stop? When? Am I going to sell? How much and where? Is there a point where I'm going to sell a little bit more and then go to a trail stop? Is there a certain candle I'm looking for that's going to tell me to accelerate my plan? The more we can plan in stage 1, there is no chimp. There's no risk. There's no trade. So there's no chimp yet. It's only the professor doing his due diligence, looking at all the angles and the numbers and right. So make sure you keep it that way. Don't let the chimp come into a process where he doesn't belong. She doesn't belong. So in this situation, that's our focus. If everything lines up, bam, we pull the trigger. We know our reward to risk. We know where our stop is. We know how many contracts. We already know how we're going to manage this trade. We are really strong coming into this trade with that type of a process. Now we are in stage 2, waiting for the trade to develop. Meaning what? Meaning, yeah, I get it. You want to pull the trigger and be like, all right, giddy up. Let's watch this thing go make us some money. But a lot of times it might go right back against you. And you're like, ugh. Right? So immediately after the trade has filled, until you say, you know what, this thing has kicked into gear and it's now in the momentum stage, you're waiting for it to develop. What are we doing here? We're waiting for whatever move you were expecting to happen to actually happen. And you have to be convinced, because you are going to take different actions as soon as you're convinced. So it can't be like, oh, it moved in your direction for 7 minutes. No, we need to be convinced that it has started the cycle, the buying cycle, and we're ready to go. What are our key considerations here? Your primary consideration is cutting losses short. This is where things could go wrong before they have a chance to go right. And if that happens, we want to be able to recognize it and fail fast. Because if we can fail fast, we're more able to fail cheap. Fail fast, fail cheap. Cut your losses short. Now, we're not going to just bail on trades arbitrarily. We're going to have some specific definitions, right? A lot of times I'm like, hey, If it doesn't break support, I'm okay. If it's already moved into a Heikin Ashi situation, I might not let it break below the Heikin Ashi before I say, you know what, I don't like that. We want to have specific signals that are helping us. And I'll tell you right now that for me, Heikin Ashi, for recognizing if I'm in stage 2, moving into stage 3, where and how can I move my stop? It's phenomenally consistent. I love it. Right? So what are we looking for? I'm looking for if the trade goes wrong. I have to be open to the trade being wrong. I should have a pretty specific idea of what would that look like. Is there a couple of candles plus volume, and a little bit of news? What is it that would tell me? Because yes, we have a stop loss. You might be thinking, wait, Scott, I thought we had a stop loss. Of course we have a stop loss. But the stop loss is your seatbelt. You get in the car, you put your seatbelt on, you start driving. If you're driving down the road and you're like, oh my God, I'm heading straight for that tree, do you think, it's okay, I have my seatbelt on? Of course not. You're thinking, hit the brakes, turn the wheel. Don't hit that tree if you can avoid it. But if you can't avoid it, good news. You have your seatbelt on. That's your stop loss. That's not your exit strategy. That's your, I've got my oh shit strategy in place, right? It's not going well, but we're okay. So in stage 2, we need to have a pretty good understanding in a way that we don't panic, but we say, I have to recognize when the probability has shifted. Could it the next day it turn around and go back? Always. It could always do that. That can't be your rationale for staying in a trade. But it might come back tomorrow. Yep, anything might happen. If we get to a point where the probabilities have shifted, so it's no longer favorable, you've got to recognize that the premise for your trade is changing. I have a trading rule that says if the original reason for your trade is no longer valid, get out. A trader gave a quote one time that resonated with me. He said, if I'm walking down the tracks and I see a train coming, I get off the tracks. What? That's phenomenal advice. Well done. Same thing with a trade, right? Train's coming, get off the tracks. That's what we're thinking about in stage 2. We're ideally waiting for it to move into stage 3 where we're like, all right, here we go. Now this thing's doing what I wanted. In that meantime, you've got to be open to being wrong, open to its probability is shifting against you, able to cut your losses short, keep them small. That's what's happening in stage 2. So we need to have clear understanding and a clear picture, a mental image of what a chart would look like, where we say, you know what, I think I need to close this at the end of the day if it doesn't get back above a certain point. Just like we need to have a clear indication, Heikin Ashi candles for me, of when a stock has moved into the momentum stage. Now, what are our risk considerations in stage 2? Initial stop loss, remember the rule, no opening pickoffs. If the stop is hard, meaning it's a physical stop that says, if the stock opens below this price, get me out. Whether it's a stop loss on the stock itself or on the option. If you have something that's going to trigger a market order on the opening price, I don't want that. That is going to substantially increase your potential for risk. So yes, I like initial stops. No, not if they're going to get picked off on the opening tick. Versus a mental stop. Do I have a place that if it at the end of the day crosses below a certain threshold, I think, you know what, I'm probably going to just shut this down and cut my loss short. I also have a time stop. If I think it's going to take 8 days, then it better be to stage 3 by day 4, halfway, or that's it, the stop. Now, I'm not going to just be like, oh, we didn't make it, I'm out. I'm going to say, all right, I'm going to give it one more day, but I'm going to tighten my stop up real tight, an ultimatum stop. Because the longer it takes for the buyers to come in, the more likely it is that that trade may not actually come to fruition, right? The probability, the longer it takes, the more the probability is shifting against us. So I want to have a time stop. And I need to have a clear consideration of when have I entered stage 3, because stage 3 is when I'm ready to start raising my stop loss considerations. Probably not to break even initially, but we're going to be able to take a pretty good chunk of risk out of the trade when we first hit stage 3. What is the main? I'm sure that there are more than one trigger that momentum is done. Yeah. What are we watching? Candles. Do we see shadows where it goes up and then comes back and it doesn't hold those highs? Shadows on candles. On Heikin Ashi candles, we see lower highs and smaller bodies. We see things like lower volume. We see things like stochastics entering the overbought condition and starting to pinch, even if it hasn't turned. Those are all now. Now, have we seen those things happen? And then all of a sudden, boom, it goes higher. Check AMD. Of course, we see that. But like you said, what are the things that tell us it looks like momentum is starting to ebb? Right? We're nearing resistance, whether that's a resistance point from history, whether that's a projected move based on the average projected move over the last period of time. Yes, there are a lot of ways, but there were 3 of those simultaneously where I say, oh, hold on a second. I need to check the connection on my mic. One little jiggle and it pops out. Okay. I hope that makes sense. Okay, let's move on to stage 3 momentum. Our favorite stage. This is where it's like, okay, I'm right. Okay, it's doing what I asked. It's moving. Let your winners run. 1, for me, the Heikin Ashi candles show me that momentum. The bigger body, no lower shadow if it's a bullish. Bigger body, no lower shadow. Now, what's happening? The stock's accelerated in the right direction. We'd love to see those Heikin Ashi stay big, but eventually they start to get a little smaller body. The highs don't get as high. That's a great sign that momentum is subsiding. We go to the traditional candles. I always look at both candles. I never look at only one or the other. And I start to see shadows. I start to see volume slowing down. And I think, oh, this thing's maybe coming to an end. Maybe. If I haven't already sold 1 or 2, maybe I sell 1 or 2. Tighten my stop on what's left. How close am I to my ultimate target? If I've still got a little ways, I'm going to say, hey, let's let it ride and see what happens. Great stuff to add to the trade strategies in the trade plan. Yes. Love it. Sandy, love it. Every trading system could potentially have their own different variations of what stage 1, 2, 3, and 4 are. But they should all have stage 1, 2, 3, and 4, right? No matter what kind of trade I'm taking, I need to be able to define those things. Considerations. If it hasn't already, we should start raising our stops. Trailing stops, whether it's hard trailing stops or mental trailing stops. Our key focus is manage our skewing reward to risk ratio. What does that mean? It means that if I get in at $50 with a stop at 48 and a target at 56, that's 3 to 1, right? $2 to the downside, 6 to the upside. If that stock goes to 53 and my stop is still at 48, I'm now risking 5 to make what? 3. Risk 5 to make 3. What the hell? What happened to my 3 to 1? So in that case, I need to be like, you know what? Let's move my stop up $2. Now I'm only risking $1 of my original money. And I'm risking no, let's raise it to break even. Now I'm risking 3 to make 2. I'm still in a negative spot, but it's a whole lot better than it was. No, 3 to 3, 1 to 1. But we need to make sure that we're considering, now that I've gotten closer to my target, my reward is getting smaller. And I'm moving farther from my stop, my risk is getting bigger until we start to move the stop. Then we're maintaining So it doesn't, we're not trying to maintain what we started with. Your ratio is going to be 1.5 during momentum because it's working. You don't want your stop to be so close that you trip yourself out of the trade, but we do want to be taking risk out of the trade. So the other thing, now we can look at stage 3 as being early or late. Early stage 3. For me, when we're getting close to like a 50% profit threshold, we're there. 30 to 50% of what our profit potential is, that's early stage 3. 50 to 70%, that's late stage 3. So there's a pretty wide range of where it's like we're in a profitable situation. We definitely have more that we could be making, and we don't believe it's entered stage 4, which is nearing completion. Are we able to add a stop to an existing trade? You can put a stop in anytime you want. Anytime you want. You decide, you know what? I'm going to stop out if this happens. Boom, automatic order. You know how I feel about automatic orders. What are our stage 3 risk considerations? Managing the dynamic stop, meaning you're starting to move your stop. You've got to decide how close. Is it automated? Is it a conditional stop? Is it a trail stop? We want to let our winners run. Don't get in your own way by putting a stop too tight. We want to maintain an ongoing assessment of the reward to risk ratio. So if we start with a 3-to-1, and then all of a sudden the stock goes $2 in the right direction, now all of a sudden we're risking 4 to make 4. We're at 1-to-1. I don't want it to drop much more. At that point, I need to take $1 or 2 off and start to move the stop. Maybe I move the stop halfway to break even. Now I'm maintaining a consideration. There's not a specific goal that I'm like, I don't want my risk to reward to ever fall below a certain point. We just want to make sure that we're aware of it. And if you start to hit a point where you're like, oh, this momentum slowing down, your stop loss strategy is going to tighten up real quick. You're going to be like, hey, I'm not willing to let this thing jiggle around much more at this point. Whatever might put you into that mindset, that's typically the course of action that will follow. We need to have a sense of when and how much to scale out. Ease pressure. What's the target to ease pressure? So if in that situation, if I had that trade where I'm in 50 and it gets to 54, I think, you know what, I'm going to sell one of my 4 contracts at 54. Still has $2 to go, still has plenty of room to go, but I've achieved a 2-to-1. Let's sell one contract. I still have 75% remaining. Or if I had 100 shares, let's sell 25 shares. I have 25 more to go. I can tighten up my stop on what's left. So if all of a sudden it fell apart, I made 2-to-1. Even if I broke even on everything that was left, I still make money. Right? But if it goes up to 3-to-1, now I can sell all of that at 3-to-1. Okay. Those are the scaling strategies that I think really make a difference in your trading. Last consideration, when to change your time frame. That's another thing. If you get to where you think it's getting close, what can I do? I can move from a daily chart to a 4-hour chart. And now if I start to use, instead of using daily Heikin-Ashi trailing, which are going to lag considerably, I could use 4-hour, which is going to get my stop loss much closer. So that eventually when this trade falls apart and drops, the tighter my stop is, the less I give back. That's the thought process as we get into late stage 3 and early stage 4 is we're now moving into protect profit. We're no longer in let profits run. Now we're starting to think, hey, we let it run. We did a good job. Now don't give it back. We don't let it run away. So we have to have a certain point where we're like, now I protect my profits. When does that come? Late stage 3, I can start to change my time frame, and then particularly stage 4, nearing completion. Now what? I've been in the trade 5-6 days. It's done most of what it's going to do. I'm thinking, hey, this thing is nearing a weekend, nearing expiration, nearing the target that I set. Anything that indicates the end of momentum, volume, candles, Heikin-Ashi candles. There's any number of things that tells us this thing is, the train is pulling into the station. We've got to have different considerations ready. I'll tell you right now, stage 4 is the most dangerous. I had a guy, here's an example. I had a guy, we were working together and he had a great trade on. I'm like, oh man, look at this trade. He had risked, I don't know, 500. The trade was up about $1,200. Beautiful. Better than 2-1. I'm like, all right, this thing's doing good. You ready for it? And he's like, yeah, yeah, yeah. Next time we talk, I'm like, okay, what happened? What happened? He said, oh man, it got away from me right at the end, but fortunately, I was still able to book a $200 profit. 200. I said, wait a second. Don't say fortunately. He was in a scenario where a $500 risk was at 1,200. He'd already achieved 2-1. Did he sell some? No, not yet. Oh, imagine if he had sold one of 3 contracts, right? And booked a $400 gain. That alone was more than he made by double. Just one contract. Sold nothing. Then he gave back 1,000 out of $1,200. What was his prospects? 300 more. He could only make 300 more. So he risked and realized a $300 risk of profit. It was a risk of profit. That's true. It was a $1,000 risk of profit with the potential of making $300. So he had greater than 3 of risk to 1 of reward. There was no strategy. I said that. Now here's the problem. When he puts that in his trade log, it's a winner. It's a winner. He made 200. Great. Chalk it up. The winner's got another win. And 2 months from now, when he looks back, there's nothing about that trade that's going to be like, you cannot let this happen ever again. And so, right, my job was to illustrate you cannot let this ever happen again. Right? That should never happen at that point. When we get to that point in a trade, should be a guarantee almost that we're walking away with profit. It's just what level. So, what was the mistake? He was in stage 4 and just had no concept of what he needed to do, how he was going to do it. When are we in stage 4? Like we said, nearing the timeline, nearing the target, nearing the expiration, nearing the end of momentum. This trade's coming to an end. What's happening? There's not likely much reward left. If you only have a little bit of reward left, how much risk are you willing to take it? You're probably going to get to a point in some trades where you actually can't find a place where you're comfortable taking risk relative to the amount of reward that's left. And you're like, no, I'm done here. Right? Maybe you were thinking you'd get 3-1. You're at 2.7. You can't find a good place for a stop or to be wrong. And you're like, I'm done. I'll take my 2.7 off the table and move on. Great decision. If we need to manage the trade much more aggressively when we get into this situation. What are our considerations? You've got to maintain a positive reward to risk ratio or bail if you can't. You're done. That's one of the best things we can do is learn when it's time to be done with the trade. Key focus. Stage 4 has the greatest danger of an inverted reward to risk ratio. So we need extra diligence. We should be looking at a trade a few times a day, not just once a day when we get here, if possible. It's not always possible. I get that. If you can't, then be more aggressive with how you put your stops in place. Stage 4 needs to be really handheld at the end. Right? It's like a noose. The higher it goes, the tighter, the more aggressive it gets. That's how our trade management should work. What are our risk considerations? Make sure you're changing timeframes to improve your perspective. Move down to a 4-hour chart. Move down to a 1-hour chart. There's absolutely times where I go to a 1 hour and I'm like, okay, I'm going to find support on a 1-hour chart. If it breaks support on the 1 hour, I'm done. I'm so close to being done that if that happens, I'm out. And if I don't like that stop, if I'm like, that's still too much risk, then we're done here. We're out. That's it. It's actually quite a great mechanism and methodology to help just make some of those hard decisions where you're like, should I or shouldn't I? We have to prevent an inverted reward to risk ratio. There's not much meat left on the bone. So you shouldn't be taking a lot of risk for that little meat that's left. We're willing to take risk in stage 3 when we have still a good piece in front of us. Definitely be thinking about an automatic sell order at your final price target. If it gets to your level, done. If it's the stock hitting a limit, if it's a conditional order to sell the option, if it's that the option price reaches a certain point, definitely let's take profits in an automatic fashion if possible. God, I can't tell you how many times I've had it or I've talked to people where it got to their target, 10 minutes later it's not there, and it never gets back. Be ready. Doesn't have to be selling everything. Sell something when it gets there. And then make sure you have a second scale out thought process. If you sell one piece, is there going to be somewhere that you sell another piece? Are you then going to implement a trail stop? What kind of methodology are you going to have to ride this thing out and finish it up? Okay. Summary. Every trade you should be like, yep, this is stage 2, right? This is stage 2. Oh, look at that. Starting to move. We're in stage 3. And when it gets there, you know that things change. Your perspective, the charts you use, what you're looking for, what are you willing to let it do, right? Risk management. We need to recognize the stages of a trade from free trade to exit. They're essential for effective risk management. We need to know when to cut losses, when to take profits, when to get more aggressive, and when to be a little bit more patient. Timing and strategy. Each stage of a trade requires a different approach and different strategy. Recognizing these stages allow you to time your actions more appropriately, adapt your tactics to market condition. Number 3, psychological discipline. Understanding that trade stages gives you more discipline and emotional control. You know what's expected of you in these different stages. That's important. When you can recognize these different stages, you're less likely to make impulsive decisions driven by fear or greed. Chimp decisions, as we call them. Don't let the chimp out. Don't let him start banging on the keyboard. When the professor's at the computer, it leads to more consistent and successful trading outcomes. That's the thought process here. So, questions? Absolutely. Stephen asked if I would take a look at a chart in the IBKR Education of Options. They have a trade called a collar. Looks a bit like a vertical spread. Is that right? A little bit. A collar is a protective strategy. So what you're doing with a collar is you're selling a call. And by selling a call, you're capping. So your value, so you own a stock and you sell a call. So if let's say I buy 200 shares of that stock at 50 and it gets up to 53. Well, at 53, I can sell a $55 call and collect a little bit of premium. And with that premium, I buy a $50 put. Stock's at 53. So if the stock goes over 53, I make money all the way up to 55 because I sold the call at 55. So I still have a little bit of upside potential. So in that regard, it does behave a little bit like a vertical spread, but I can't, over a certain point, I can't make anything because I sold the call. Somebody else has the right to my stock at that point. The collar is I use the premium from selling that call to try to pay for a put. So it's like a free insurance policy. I sell the call to buy the put. So if I go down and I buy the $50 put, that's a little bit out of the money. Well, what that means is if the stock drops to 51, nothing happens. I'm down a couple bucks. If the stock drops to 41, I've protected myself with that put and I have that insurance policy. And so what that does is it means that I can't lose more than a certain amount. So the ability to not lose more than a certain amount or gain more than a certain amount in that regard does create a risk profile that makes it behave very similarly to a spread. What are the differences? Well, number one, to do a collar, you have to own the stock. So it's a much higher capital requirement than the capital requirement to do a spread. We don't need to own the underlying stock. So that is a color. Next up is trading psychology. Today, Stephen wants to take a look at IBM, and I agree. Let's take a look at IBM. Market was looking pretty good today. Pretty good today. Okay, IBM. Set a call strike at 162. So you bought a call at 162.50, which was initially out of the money. Cost a lot for the option trade. I'm up about 140. AI shows the stock still strong momentum as you get closer to earnings. My target to get out at 170. Okay, so a couple of things here. We've got earnings. Now I have 3 days in a row where it hasn't gotten any higher. And on this day, it had a shadow that went up, came back down, and it actually finished lowered. Today, the sellers pushed it to here, but then the buyers pushed it back up, and we're still at this same level. What's happening with volume? Volume is diminishing a little each day. So if I put this on Heikin Ashi, you'll see what's happening. My candles are getting smaller and smaller. And then today is the first day that I have a lower high. So I definitely think that and I have a lower shadow on the Heikin Ashi. I have stochastics that's overbought and crossing down. So there's definitely multiple signs that say the momentum on this has subsided. Has it turned? No. But yeah, I'd be in here, it looks great. Your stochastic is moving up, bouncing. And then all of a sudden here, that's the first time we're like, whoa, wait a second. Now we didn't panic. We gave it another day. You can see still couldn't advance anywhere. Still the threat of sellers underneath us here. I'd be very concerned about this. I'd be very concerned about this not losing. Now you can see here, if I go down to the Heikin Ashi and I take this to a 4-hour chart, this thing's already started to show a little bit of weakness here. And you might say, you know what? I'm not going to let this thing drop below 165.70. If it can make another run with these 4 hours, if it can do this again, great. But if it can't and it falls from here, we're done, right? We're done. So this is just, you can use these different reference points to help you bail out. Give it, hey, maybe it does keep moving. Maybe it does. From this chart here, it looks like it could be trying to go again. So if tomorrow it opens higher, great. Then what? Then move a stop up underneath here. See if it gets up to your 170. Have an order ready at 170, gone. At least half or whatever. Something has to be sold at 170 when it gets there, if that's the target. And then there has to be a mechanism for how do I control it as it moves up? Only one contract. There you go. All or nothing, baby. I'm glad it's helpful, Sandy. I'm glad you guys are willing to share your trades because yeah, these are the considerations, right? There's no right answers. There's just different answers that have different levels of risk and reward, different probabilities. And we have to just make sure that when we combine those risks, rewards, and probabilities, it makes sense. All right. Anything else? I love it. Where is this trade for me? Stage 4. Stage 4. Let me go back. Here it is in stage 1. These 2 days at stage 1. Actually, stage 1 could be all the way back here even, right? It could be here. And then we get in the trade, maybe one of these 2 days. Now you're stage 2. By this day, stage 3. The candle is turned on you. Stage 3. Now what? Now we're hitting stage 4. So we spent about 3 days, 4 days, but now we're starting to realize, hey, this thing is starting to come to a close. We're reaching stage 4. It's gone further than this before, right? But it's also failed the last 2 times. So we have to balance how this thing has moved historically, what we've gotten, what are we willing to risk relative to what may be in front of us. Phenomenal discussion, right? That's a great ability for us to sort of look at these stages and how they would appear real time What would we do with it? How would we see it? Love it. Love it. Love it. All right, you guys. We'll wrap the week up tomorrow. We have our wrap up in the afternoon. So, yeah. 3:15 p.m. Eastern. If you had put a stop halfway up the second to last Heiken-Ashi, it might be up. On the 4 hour, that's true. Here you would still be good. Here you would still be good. Put it there. Maybe now you're moving it up. Yeah. I think you could justify a stop anywhere between 164.12 and 165.75 and still give it a little bit of room to try to catch some momentum. I'm glad it's worth watching the recording, Fred. Thank you. Everyone have a great night. See you guys tomorrow. As always, happy trading.